Okay, in this video, I'm gonna go through a couple of questions that was asked by the audience. So this audience member is called Brendan. He's about a 20+ year old person and he's looking to start investing. He does not have a finance background. Okay, and keep in mind, I'm answering these questions and this is not financial advice. This is just my opinion. Okay, you may disagree with me. It's fine. It's the internet. You're watching YouTube. Literally nothing matters. Okay, so yeah, this is the perspective of an audience member asking. I'm just gonna reply. Okay, so the first question he asks is, what platform should I use to do investments? So there's a lot of brokerage trading accounts, trading companies in the world, like Moomoo, IBKR, Charles Schwab, Robinhood, eToro, Webull, right? What matters is that if you put money somewhere, you want to make sure that your money is safe, all right? That they're not going to run away with the money. In the case with FTX, for example, FTX was a brokerage account for the crypto space, and then they ran away with people's money, right? So you just want to make sure that you are on a trusted brokerage that has been there for a very long period of time. They have a reputation, so yeah, it's important. Me personally, I use IBKR. I'll put a link down below. But you may use something else as well. So if you want to use IBKR, I'll put a link down below. If not, there's literally many other options as well. Okay. Question number two, what factors do I have to account when deciding what stock to buy? Okay, so this is a very subjective question because I don't know what stock to buy. But what factors do you have to account for? Okay, so you can actually use the Stock Penguins tool to actually guide your decision in a sense. Okay, let's go to the Amazon example and let's see. Okay, so if you're trying to buy safe companies, if you're trying to be a very safe investor, you want to buy safe companies. The reason why is because they grow steadily. They're not crazy growth, but they will grow nonetheless at the end of the day, and they can make you very rich. Like don't think safe companies as you get rich slowly, right? It's like all the big companies will grow eventually if they are a big company. That's why they are the safe companies. Okay, so don't think this is a low percentage return or what. 5 to 10% a year is a respectable amount, right? 10 to 15% a year is respectable as long as it's outperforming the index, which is historically at 7%. You're actually pretty good. Okay, so you generally want to buy companies that are profitable, okay, and they have growing revenue and net income. All right, so if I go to the stock over here, this is Amazon, right? If I see on an annual basis, for example, if you see their revenues have been growing every single year, right? This is a very good sign because it shows me that the management or the people in the company know how to make more and more money every single year. Okay, that's a good sign. That's number one. That is growing revenue. Okay, you want to see growing net income as well. So net income is basically this thing over here. Net income is basically profits, right? You want to see them increase profits over time. Okay, so you see the net income. It was around 21 billion here. It was 33 billion, and then it went down a bit. Okay, it went to negative 2 billion in 2022. Okay, so is that a good sign or a bad sign? So this one is a subjective thing because you need to look at a specific company and assess by yourself. In this case here, this is Amazon, right? So you need to understand the Amazon company, what happened in 2022, stuff like that. So basically they had a lot of capex and stuff, and so they were spending a ton of money. And then like minimum wage issues, so then they had to pay the employees more, so their net income was basically lower, right? So in this case here, it's a very subjective thing about the company, and that's why their net income is lower, right? And if you're okay with that, then you can continue to invest in this company. But if you're not okay with that, then the business is going to invest in itself. Then yeah, don't buy the company. All right. We'll give another example here. So we'll give Nike. Okay. If you see over here, the net income 1.2, 1.03, 1.45, 1.57, 1.1. Right. So Nike is a very big company. But if you see the net income is not really increasing, right? It's going down. It's going up. It's going down. It's not a very consistent growth rate. It's not very consistent at all. And that's why I personally don't buy Nike. Because I know how difficult this consumer business is, and you can see like the fluctuations in the net income. It's not consistently growing, right? Right. So, but we see something like Apple. Apple is a fantastic company, right? Generally, their net income, it grows. Once again, it's going up and down, up and down. All right. Maybe we take a look at a software company because software companies are generally they should grow. Okay, this one's a bit skewed. If I choose Salesforce, for example, okay, so you can see generally software companies, because there's recurring subscription, their net income should generally increase in a linear fashion. Okay, you can see over here. Let me search Costco. So Costco is a supermarket chain. All right. And so even though you can see the numbers very small, 1.3, 2.1, 1.5, 1.7, 1.6. So this also fluctuates. You can see that the net income is not increasing over time, right? So if that affects your decision on whether you want to buy the company or not, then don't buy the company. But if not, you can buy the company. What I personally like, that's why I say this is not financial advice. This is just my opinion. I want to see revenue increasing. I want to see net income increasing, because you're making more money and you're making more net profit at the end of the day. Makes sense, right? Like you should be generally making more profits every single year. Yep. Okay. The next one that I look for is that it has potential to grow in the next 5 years, 5 to 10 years. There's a clear growth trajectory. Okay. So for example, the Costco business, right? This is a supermarket chain. Like, how do they actually make more money? They get more people to spend more money in their store, and they open more stores. It's a very, very straightforward business model. If you open a supermarket, right? For Amazon, for example, right? Amazon's a very big company. Where is the growth going to come from? So I know that the cloud infrastructure business is going to increase over time. They're going to have more people buy more compute because of AI, right? And so they need cloud server hostage fees and stuff like that, right? So I know that this space is going to grow because there's more demand for it over time, right? So there's a clear growth trajectory in the business, right? For the next 5 to 10 years, like you are not scared that this business is going to die, all right? Yeah, and once again, stable growth, consistent business, right? So you can think about all the biggest companies in the world, like McDonald's, JP Morgan is a bank, Google, for example. Are more people gonna Google stuff or less people gonna Google stuff, right? So ChatGPT just came out, so that may not be the case. But if you are confident in the fact that more people are gonna use Google, then yeah, more people are gonna watch YouTube, much more people are gonna Google, and so this is a safe bet, right? Microsoft, more people gonna use Microsoft Excel and Office in the next few years. Yeah, probably so, right? Probably so. And as I mentioned, Costco and Walmart, they're supermarket chains as well, right? Yeah, so the question you have to ask yourself, right? It's like I can't give you a straight answer because business has risks and this is not a financial advice channel at all. I can't give you financial advice. But the question I ask myself is, will this business exist in the next 10 years? And in 10 years' time, will this be bigger than before? Yeah. All right, so that's buying safe companies. If you are a very risky person and you want to have high growth or whatever you want to call it, you want your portfolio to grow very fast, you want to consider high growth companies, right? And then usually you're buying generally stuff that has revolutionary tech or they have a superior business model. And so you have high growth potentials over here, right? But at the same time, you must be prepared to lose all your money because, yeah, it's a risky business. It's a risky business, right? So people don't understand with risk comes reward, right? So you got to be prepared to lose your money if you are going to high growth. Yeah, you only can blame yourself basically, right? And lastly, there's something called an ETF. Okay, you can buy an ETF. An ETF is basically a basket of stocks. And then let me show you what ETF does. Okay, so an ETF is basically a basket of stocks, where you can see here an example of a basket of stocks is S&P 500. So there are the top 500 companies in the world. You can take a look over here in stockpenguins.com. If you go to top companies, you can see these are the top companies in the world, ranked by market cap. Let me just change it to 100. Okay, and you can see all these companies, they are basically in the same index. Okay, all the biggest companies in the world, they are tracked in the S&P 500, and they represent the 500 biggest companies. Yeah, so if you want to buy an ETF is called an exchange traded fund. Yeah, then it's a safe bet because even if one company goes down, you got 499 other companies that are pulling the index, right? The total volume of the index. All right, there are other things like the VTI, the iShares, and stuff like that. And then this is called a broad market ETF. So it's like the total market, and then a sector in industry. So like technology sector. So all of the technology stocks, for example, all of the healthcare stocks, for example, all of the banks in the financial tech sector over here, fintech. All right, then there's an international ETF. So you can invest in the European markets, you can invest in the Asian markets, you can invest in China, Japan, right? If you think the Japanese economy is going to grow, then you should probably buy the ETF for Japan, right? And then the bond ETF, I'm not very familiar with bonds, but there is a bond ETF, just FYI. Yeah. Commodity ETF, so they track the price of gold, oil, agriculture, stuff like that. The price of gold, you can see the price of oil. right? So I mean, if you're not in these markets, you generally don't understand what's happening. So I wouldn't advise you to actually do anything about it. Yeah. And then real estate ETF tracks the performance of investable market shares. If you don't know about real estate, probably don't touch it, right? Thematic ETFs. So this one recently, for example, this is ARK Innovation ETF. So this is Cathie Wood. She has a thematic ETF. So her entire ETF is based on the thesis of focusing on investing in innovative technologies such as genomics, automation, AI, right? So all the stocks she buys are basically this thing right here. And so if you believe in her vision, if you believe in her mission, that these companies are the future, then yeah, this is your ETF for you, right? Then there are other ones in robotics, and solar energy, etc., etc. All right, and then lastly, there's dividend ETF. So it tracks the performance of the US Dividend Achievers Select Index. So the stocks that are basically paying out dividends already. Yeah. All right. So if you're a beginner, I wouldn't suggest you do anything about this information. Just focus on the broad market ETFs. All right. The next question is, how long should I hold a stock for and when to sell the stock? Once again, not financial advice. This is my opinion. Okay, so I always hold a stock and I don't sell a stock as long as I believe in the growth of the company. Okay, as long as I believe that this company will grow, the people running this company are good people and they are competent people able to grow the revenues of the business, I will hold the stock. Okay, I only sell a stock when the fundamentals change. Okay, don't sell a stock because you read news. Okay, you want to sell a stock only if you believe the fundamentals change. So let's define what fundamentals is. Okay, so the fundamentals include declining revenues and earnings, right? So if you see that a stock is, let's see if this one is going up or going down. Okay, so Costco, for example, over here you can see this like increasing earnings, increasing revenue over time, right? They're making more money every single year, right? But what if they are making less money every year, right? So recently, I believe Lululemon, if I'm not wrong, I think they reported bad earnings. Yeah, there we go. They reported bad revenue. So it was like Q4, and then Q1. You can see here, in Q2 2023, they reported 2 billion, and then Q2 2.2 billion. So they basically did not really grow. They did not grow revenue like quarter over quarter. You can see, right? And then investors were spooked because in Q1 they did very well. They did like 3 billion, and it went down all the way to 2 billion, basically almost 30%, right? So generally, when there's declining revenues and earnings, and when there's an expectation that stuff is gonna get bad, this is what happens. Okay, this is what happens. This is what fundamentals mean, right? Second one is management changes. So for example, if this company CEO changes, and you don't like the new CEO, or you don't like the new CFO, or whatever it is, or you can see here the CEO or CFO, like they resign unexpectedly. It generally means there's something happening in the organization that people don't want to be there, right? People don't want to be there. Something bad is gonna be go wrong, right? So if you believe that in the management team, and the management team believes, then that may be a consideration for you to sell. Okay, deteriorating industry conditions. So for example, okay, this one is about pharmaceutical industries, but I'll give you about newspaper example. If you are imagine you had a newspaper stock, and the newspaper industry is going down because digital and YouTube is coming to take the advertising dollars, right? Yeah, that's probably a reason why you should probably not be in the industry, right? That's a reason why. The next one is increased debt levels. Okay, so like obviously when you have more debt, you need to pay off the debt before you can start making money again. So you can actually check debt by here. So over here in Stock Penguins, you can see cash versus debt. You can see like you generally need more cash than debt because well, you need cash to survive as a business, right? If you don't have cash, you're screwed. Okay, so you this orange graph should always be below this blue graph. Otherwise, you should probably reconsider your stock. Okay. Loss of competitive advantage. So this one is an amazing example. So Google and ChatGPT, right? So Google's business is based on advertising, but now a lot of people are going to ChatGPT to basically search for stuff. They're also going to TikTok to search for stuff. So that means Google is going to have less people using it, right? Or less advertisers are going to be on Google, right? So there's a loss of competitive advantage, you could argue, and that probably means if you want to sell Google, you could probably do so, right? Okay, change in market sentiment. Okay, so okay, this is an amazing example, but change in market sentiment. For example, there's this company CrowdStrike, which caused a big IT outage recently, and you can see, for example, the sentiment of the entire company just completely just dipped over here. Yeah. Whose fault is it? It's nobody's fault, but you can clearly see it's really affecting the stock price right now. Yeah, it's really affecting the stock price. Yeah. Okay. Yeah. So that's a change in market sentiment. Poor financial health. So you want to see liquidity ratios, solvency ratios, cash flow and stuff. Okay, so this one is not, it's obviously important, but if you cannot read metrics and data, it's totally fine. What you want to see is that obviously they have enough cash to survive. Yeah. And basically you want to see net income, you want to see revenues and stuff like that. Okay, because if you start reading a lot of this, how do I say this? If you see like cash to debt ratio and you don't understand how it is, it's going to confuse you a lot if you're a beginner. Okay, so if you don't want to get confused, just focus on increasing revenue, increasing net income, enough cash on the balance sheet. Yeah, they're trending in the correct directions basically. Yeah. All right, next one, how active do I need to be in the market? Okay, so this question here, this depends on how much you care about the markets, honestly. So I like watching financial news, but you may not. And like news just generally means opportunities to buy. Okay, but technically if you bought the index, you don't have to check the markets. If you don't want to check the markets, you don't have to. Okay, but if you want to buy stuff, or you want to sell stuff, or you want to just make sure, you can always check the markets whenever. But obviously don't be obsessed with it if you don't care about it. Okay, like you don't want to be itchy fingers and stuff like that. Okay, there's actually no need to be active if you don't want. Okay, so if you want to buy the index, let me show you the index. This is the index. Okay, the index is safe because most of the top companies are over here. It generally moves in an upward direction, you can clearly see, right? So you don't actually have to obsess about it, you just need to know what to look for. And on like how often you want to check, I mean, depends on what you want. It depends on what you want, honestly. Okay, lastly, where can I go to learn more about investing? Okay, this is what I recommend. I don't know what you will recommend, but I like Peter Lynch a lot. He explains very complex stuff with very simple English, and it's very, very common sense. So I like Peter Lynch. You can check him out on YouTube. He has like 20 to 30-minute videos on YouTube from his 1 hour speech. It makes a lot of sense. It's very, very easy to consume, especially for beginners. If you want to go hardcore, Intelligent Investor is a very big book, but this is the book that Warren Buffett, I believe, and Graham, I forgot his name, yeah, his mentor wrote, I believe, for Warren Buffett. So this is a very popular book. And then I like Peter Lynch a lot, so I like Beating the Street. Yeah, that's about it. Thank you.